This is Ashok Memori's first one-on-one quarter actually with CNBC TV18. Thank you so much, sir, for speaking to us. My first question, of course, you said that 2015, that is the calendar year 2015, is expected to be better than 2014. Tell us, what is the commentary that you are witnessing from clients when it comes to the deal pipeline? Is there a significant uptick that you're witnessing when compared to last year? And, where are the areas that you are seeing an uptick? Because from your peers, especially your domestic peers, we have seen words of caution when it comes to North America, when it comes to Europe, even when it comes to the emerging geographies.
So we were basically going into 15, we are actually seeing a better pipeline than we were going into 14. We think that we have a lot more confidence it's not just about the pipeline, the number of deals or the value of the pipeline, but the quality of that pipeline as well. We clearly expect to see on the back of a resurgent U.S. to continue to grow that market. That's our biggest market. We're seeing good traction in the BFSI space, especially in the financial services space. We're seeing good traction in retail and CPG. We're seeing, and that's backed by the number of deals that we have won. If you look at our client opening, that's very broadly spread in the U.S. with manufacturing, in BFSI, in retail, CPG, etc. We think that in the European market, the markets that we have chosen for ourselves, UK, the Nordics, Switzerland, increasingly trying to find traction in Germany, these are the markets which will continue to find, despite the macroeconomic volatility and talks of contraction, etc., that they will continue to find the opportunities for the value proposition that we are bringing to the table.
Customers at this point in time across the world are looking at cost optimization. As you said, there has been a focus on digital while customers are optimizing. You are the only player that has actually made a separate business vertical for digital. What kind of growth are you witnessing over there? And can you put a number to the traction you're seeing in the market?
So digital is a very interesting space for us because it is, albeit though it's small, we've grown this year at 40%.
40%.
And we think that that is really the cutting edge in terms of engaging with clients and to essentially build on where their monies are going. So which is why we've moved, for example, our head over there. We're hiring fairly aggressively for our digital practice. But I think the point about cost takeout is actually, it's not so universal anymore. If I look at the clients in the U.S. marketplace, the focus has shifted to the revenue side of the balance sheet. They are looking from a technology perspective to become much more competitive. That is why digital is finding so much traction. They're looking for processes. They're looking for utilities that can provide them with cost and efficiency, which will help drive business from a revenue perspective as well.
Okay, I want to understand your perspective on pricing. There seems to be a certain amount of pricing pressure across the industry. As you did say in the press conference, there hasn't been a significant pressure you're seeing in specific clients or specific geographies. Can you tell us where is price realization, or what is your outlook on price realization? And also if you could just give a quick idea about margins for the quarter.
So the entire 2014, we have seen price realizations to be fairly steady. If you look at the core of the business that we do, which is tended to get commoditized, there is a certain amount of it's difficult to actually get a price increase. I mean, if you can maintain the prices that you have and hope to get some premium over your competitors, you've done a good job. I think there is a certain amount of a large amount of automation that's getting driven in the system, and as a result, some of our larger competitors are finding it difficult, for they will have to cannibalize their very large workforce-based business model. But clearly, it is pricing has been on the if I look at my value proposition, moving up the value chain from an ITOPS perspective, pricing has actually tended to go up. If I look at my digital, of course, the pricing is very competitive and very high. But on the digital side, on the margin side, it's predominantly on-site till we actually are able to make that business model a much more offshoreable model. The margins on that will be quite low.
Okay. Europe has seen a significant uptick on a quarter-on-quarter basis as well. 2 quarters ago, we were talking about compression in Europe. We were talking about how Europe has been witnessing some amount of pressure. Where are the areas that you're actually seeing growth? And, are clients looking at discretionary spending differently, European clients?
So, well, I don't understand this whole myth of discretionary spending. Nobody has any discretion on spending. It has to be planned, whether you're a client or whether you're an IT services provider, whoever you are. In Europe, we're actually seeing traction in our typical markets. I think we have been mining that market for a while. BFS is clearly an area where there is pent-up demand. and I think we've been able to leverage that quite effectively. So we actually think that both markets for us, which is the US as well as across the pond, have the opportunity to expand for the value proposition, especially as we are creating knowledge services utilities. As we are building platforms, we are finding the uptake of that to be much more robust than maybe traditional businesses.
Okay, fair enough. In terms of individual vertical outlook going forward, retail energy seems to be contracted for 2015, while your exposure isn't as significant to these two sectors when compared to financial services. Could you tell me, in terms of the risk coming in from these sectors, is it very significant in 2015?
So if you're talking about energy and utility sector, yes, we have a very limited presence in that. So we have not been impacted. But of course, if oil prices go down, that sector is obviously going to get impacted. But what it does, on the other hand, is that it makes the other industries, the other verticals, that much more competitive, in the sense that they begin to grow much faster because of lower oil costs or lower energy costs, and therefore they have the desire to spend more. So in a way, it is a good thing that we were not in that space and we are in the other spaces.
Okay, fair enough. Also, in terms of your outlook as far as digital order book is concerned, if you could put a number to 2015, how significant would it be?
So we did 40% growth this year. I think we'll probably do similar to slightly higher numbers for 15.
Okay, fair enough. Also, you've been rationalizing non-strategic clients. You've been rationalizing the smaller contracts. How much of a benefit has that been on a full year basis, on a calendar year basis? And going forward, are there further contracts that you need to rationalize, or?
Yeah. I think we're in a good place right now. I think for a company our size, we have 281 clients. As I've always said, it's important to go mile deep rather than be inch wide. So the whole conversation for us is more about being tightly engaged with our strategic clients. I don't see any benefit by tom-tomming the number of new clients that we have added. With the clients that you have, if you can service them well, I think you've won the battle. But clearly, it is we are seeing traction in these clients. We have some of our clients have been with us for 10, 12 years. Obviously, whatever we're doing a good job of it, and we are adding more to that, which is resulting in client, revenue per client metric actually improving by 18% year over year.
Okay, fair enough. Last question. You've now moved from just-in-time hiring to hiring for growth. Are there targets that you've set for the full year 2015?
So we have some numbers at a gross level. The business heads basically do the planning on that numbers based on the demand that they see. As you know, our business units are standalone, so they make a consolidated thing. And so numbers will not be probably as high as last year, but they'll be comparable.
Okay. Also, what is the pricing pressure, or what is the competitive pressure that you're witnessing from your peers right now? Because there's a lot of price tightening in the industry. How significant would that be going ahead?
Well, what I was saying, we do have situations where incumbency tends to, when it's thrown up for competition, tends to create a sort of adverse or negative price decision making or price reaction, which is unhealthy for both the people who do it as well as for the IT industry and other participants in it. So we do see some erratic pricing behavior, but fortunately it's limited, and it does not necessarily bother us as much because we are not on a price game here, we are on a value game.
Okay. And it's been a few quarters since you've been at iGate. How is life different now versus it was when you were at Infosys?
Well, it's very interesting. I have a great team. It's a company with significant amount of energy. We have very, very strong client relationships. We're growing. So when you're growing and when you're innovating, when you're doing new things and you're doing things differently, it's always fun. And I'm having a great time.
Okay. Thank you so much.